I wasn't supposed to be in that room. And if what I heard there becomes public all at once, markets won't panic slowly, they'll freeze. 3 days ago, I walked into what was described as a routine economic discussion in Basel. Within minutes, I realized that was a lie. This was an emergency gathering of the people responsible for holding the global financial system together. And they were scared, not the performative concern you see at press conferences. Real fear, the kind that appears when models break, when assumptions fail, when control slips away. I've studied crises my entire life. I've warned about structural fragility for years. But watching central bankers, people with access to every capital flow, every market signal struggle to stay composed, I understood something chilling. They already know what's coming. They know it's worse than what's publicly admitted. And most alarming of all, they no longer believe they can stop it. If you think this is just another economic cycle, pause, don't scroll, stay with me, because what was discussed in that room changes how you should understand stability itself. And to see why panic replaced confidence, we need to step back and ask one uncomfortable question. Let me be precise about what that meeting was really about, because the official language was a distraction. On paper, the agenda spoke of normalization, of fine-tuning interest rates, of stability returning after turbulence. But within minutes, it was clear no one in that room believed their own documents. The real discussion wasn't about policy. It was about survival. The question they were wrestling with was brutally simple. What happens when the system that everyone depends on stops being trusted? Not hypothetically, not someday, now. Because when trust erodes at the core of finance, mechanisms don't fail one by one. They fail together. Liquidity dries up. Prices stop meaning what they used to mean. Safety becomes relative. And decisions that once seemed unthinkable suddenly appear on the table. What struck me most was not disagreement, but consensus. An unspoken agreement that the old assumptions no longer hold and that pretending otherwise only makes the eventual reckoning worse. This is why that room felt heavy. They weren't debating theories, they were mapping consequences. And to understand how we arrived here, we have to rewind beyond headlines, beyond recent shocks, and look at the deeper origins of this fragility. To understand why that room in Basel felt like a countdown chamber, we have to move backward past personalities, past politics, and look at structure. For decades, the global economy rested on a simple assumption. The dollar was not just dominant, but unquestioned. It was the settlement layer beneath trade, debt, pensions, and savings. That dominance allowed the system to absorb shocks that would have shattered any other arrangement. But dominance is not the same as resilience. Over time, the system accumulated imbalances, persistent deficits, asset freezes weaponized through sanctions, financial engineering replacing productive growth. Each decision made sense in isolation. Together, they created fragility. What central bankers now see clearly is that trust was the invisible pillar holding everything up. And trust doesn't collapse linearly. It erodes quietly, then disappears suddenly. This is the economic cycle no textbook prepares you for. Not a recession, not a correction, but a transition where the old anchor weakens before a new one exists. That's the historical context behind the panic. Not a single bad year, not one policy mistake, but the end of a long phase where assumptions outlived reality. And once that realization sets in, events stop being random. They become signals. Which brings us to the first moment when theory collided violently with reality. The first real shock in that room came when pretense finally collapsed. A senior official stood up and said what no public statement has admitted: Treasury demand is no longer behaving normally, not temporarily, structurally. Foreign holders are pulling back faster than reported, and if they did it openly, the market would not absorb it, it would break. What followed wasn't debate, it was disclosure. One by one, officials acknowledged the same reality using different words. Selling is happening quietly, indirectly, through intermediaries, through swaps, and offshore channels designed not to solve the problem, but to hide its speed. Because everyone in that room understood the same thing. If the exit became visible, it would become uncontrollable. This wasn't about yields moving a few basis points. It was about the market itself beginning to price risk where risk was never supposed to exist. Government debt, once the definition of safety, was now being treated with caution. That moment changed the tone entirely. This was no longer about managing expectations. It was about preventing a chain reaction. And when a system depends on concealment to survive, the question is no longer whether pressure exists, but how long it can remain hidden. That realization led directly to the next concern they could no longer avoid. What emerged next was the mechanism beneath the panic, the part never explained to the public. The system's plumbing is breaking. This isn't about headlines or speeches. It's about the repo market, the quiet machinery that allows banks to treat government bonds as cash. When that machinery works, liquidity flows invisibly. When it doesn't, everything jams at once. Officials admitted that repo rates are spiking erratically, even in calm periods. Banks are demanding higher compensation to lend against treasuries. That is not supposed to happen. In peacetime, treasuries are meant to be unquestioned collateral. But markets are no longer acting on tradition. They're acting on risk. The central banks are intervening constantly, smoothing rates, injecting liquidity, masking stress. Yet every intervention carries a message the market understands. Something is wrong. And the more often they intervene, the less reassuring it becomes. This is the hidden mechanism behind the fear. Not a single crash, but a system that now requires permanent life support to function normally. And when a system can't stand without intervention, policymakers face a darker question, not how to optimize it, but how to contain its failure. That question pushed the conversation into territory they never discussed publicly. The second crisis was not financial in the narrow sense. It was political because it crossed a line no one wanted to acknowledge. Quietly, almost reluctantly, officials began discussing capital controls. Not hypotheticals, draft protocols, timelines, coordination. The Bank of England spoke about emergency restrictions on moving money across borders. The Swiss and European officials confirmed parallel preparations, limits on currency conversion, delays on transfers, temporary freezes if pressure accelerates, all described as contingency planning, all understood as last resort measures. These are tools used in acute crises, in emerging markets, in moments of collapse. And yet here they were being prepared in the heart of the Western financial system. That's when the tension changed. Because capital controls are not technical adjustments. They are admissions. They tell markets and citizens that trust has failed. Once discussed, they cannot be undisclosed. Once prepared, they change behavior. Money moves preemptively. Confidence thins. The very act of readiness increases fragility. No one in that room wanted to activate those measures, but no one believed they could rule them out. And when policy discussions move from prevention to containment, the countdown accelerates. That shift forced the conversation toward a consequence far more explosive than market volatility, one that reaches directly into people's lives. This is where the conversation stopped being abstract and became personal. Because when systems fail quietly, it's not governments that absorb the shock first, it's you. Officials began discussing pensions, retirement funds, long-term savings built on the assumption that government bonds are safe. One estimate landed heavily in the room, losses in the range of $3 to $5 trillion if rates rise just a bit further. That isn't speculation, it's arithmetic. And here's the part that matters for you. When pensions take that kind of hit, there is no invisible buffer. Accounts shrink, promises evaporate. People who did everything right suddenly discover that stability was conditional. One official said something that still echoes with me: the public doesn't understand yet. But when they do, when statements arrive, when balances fall, the political pressure will be overwhelming. People will demand protection, bailouts, relief. And the system will face an impossible choice: print and inflate, or refuse and fracture trust completely. This is not about charts or policy anymore. It's about dignity. about whether decades of work translate into security or disappointment. If this concerns you, don't disengage. Pay attention. Share this. Because awareness doesn't stop crises, but ignorance makes them brutal. And once this pressure hits households, it doesn't stay contained. It spreads outward fast. What happens next doesn't stop at national borders. It never does. When trust weakens at the center of the system, the shock travels outward along trade, finance, and geopolitics at the same time. Allies hedge, rivals accelerate alternatives. What was once coordination turns into quiet divergence. Officials spoke openly about this global chain reaction, energy exporters reducing automatic dollar recycling, manufacturing powers settling trade through parallel channels, central banks diversifying reserves not because it's optimal, but because concentration now feels dangerous. This is how a unipolar system becomes multipolar, not through announcement, but through accumulation. Each small hedge looks rational. Together, they rewire the system. And Europe, in particular, came up repeatedly. Deindustrialization, energy dependence, strategic weakness. When the monetary anchor shifts, regions without buffers don't adapt smoothly. They absorb collateral damage. The fear wasn't about a single rival replacing the dollar overnight. It was about fragmentation. A world where liquidity pools don't connect cleanly, where shocks can't be absorbed globally, where crises propagate faster than coordination. That's why this moment matters. Not because one currency rises or falls, but because the architecture that once contained crises is losing coherence. And when architecture weakens, the future stops being a forecast and becomes a set of scenarios. When the discussion turned to the future, no one spoke in predictions. They spoke in scenarios. The first was the best case, a slow, managed decline. Over a decade or more, trust erodes gradually. Markets adjust in stages. Pain is real, but spread out. Institutions survive, thinner and weaker, but intact. This is the path policymakers are trying to engineer: constant intervention, quiet coordination, and the hope that time absorbs the shock. The second scenario was harsher. A compressed transition. One trigger, a failed Treasury auction, a sudden shift in reserve behavior, a geopolitical shock pushes the system past tolerance. Liquidity freezes briefly, then violently. Emergency measures activate. Capital controls appear. The system holds, but only after visible damage. Then there was the third scenario, the one no one wanted to linger on. A sudden break. Multiple triggers colliding, markets freezing simultaneously, currencies repriced overnight, social pressure erupting faster than policy can respond. Not a recession, but a rupture where trust collapses before alternatives are ready. What struck me wasn't fear of any single outcome. It was the admission that none of these paths lead back to the old world. This is not about restoring equilibrium. It's about navigating an ending. And when you accept that, the final question isn't what governments will do, but what responsibility remains to tell the truth before the moment arrives. That's where this story has to end, and why it can't end quietly. I left Basel 3 days ago, and I haven't slept properly since. Not because I heard a secret date, not because someone whispered a number, but because I sat in a room with people who see everything, every capital flow, every stress point, every hidden imbalance, and what I saw in them was not confidence, it was dread. They are not preparing for a hypothetical crisis. They are managing one in real time while hoping it doesn't reveal itself all at once. That is not strategy, that is triage. The mainstream narrative tells you resilience is returning, that normalization is underway. But behind closed doors, the language is different. Emergency protocols, capital controls, unlimited interventions, tools designed not to fix a system, but to delay its failure. And here is the truth that matters most. This will not feel sudden when it happens. It will only feel sudden to those who were never warned. The authorities saw this coming. They chose silence because they fear awareness accelerates collapse. Maybe they're right, but I believe something else. People deserve clarity, not comfort. Preparation, not reassurance. If the guardians of stability are afraid, complacency is no longer an option. Pay attention, stay engaged, strengthen real-world resilience, skills, community, adaptability. Because when trust in systems weakens, what matters most is what cannot be frozen or repriced overnight. This isn't the end of a cycle, it's the end of an assumption. And if you want to understand what comes next before it arrives, stay with me.